Okay, yo, let's get on with it. Welcome to Forex.Today, the YouTube community of approximately 20,000 foreign exchange traders. Thank you for being a subscriber. Let me remind you that trading is risky. It's not appropriate for everyone. Oh, no. Your past performance, good or bad, it's not necessarily indicative of future results. But please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Ni hao ma! Hey, I'm Wayne. I'm a currency trader just like you. Welcome to Quadruple, or is it just Triple? I think it's just Triple Witching Friday. So that's pretty cool. I think this is going to be an interesting day. I don't make too much of it, but nonetheless, it's an unusual day. It only happens 4 times a year. Very interesting. So, hey, get involved, ask questions. I will do my best to answer them. If you got a problem, I'll solve it, or at least I'll try. I've learned a lot of things over 20 years of doing this. Sometimes I lean on my previous careers as a high-tech entrepreneur, as a Silicon Valley investor, as a leader in a nonprofit organization. Okay, so I've done a few things and I can contribute in different ways, so just let me know how I can help. Mohammed says, are you still fundamentally bearish? No, I just became fundamentally bearish. Okay. All right, cool. So, so great. That's a great question right to start off with. So, anyways, ask questions, get involved, and I'll do my best to help. There are many resources available. I'm here to answer your questions every single day on YouTube for free. In the description below, there's a link to free training video, training video course. I think it's about an hour and a half, 2 hours long. Hey, it's helpful. It's a good place to start. I also wrote a book many years ago, and it's still valid today. The link is in the description below. There are paid video training courses, 65 hours worth for $88. Obviously, I'm not in that for the money either, but it is very detailed, and I spent thousands of dollars developing it, many thousands. So anyway, so there's something there. Also, you're going to need a broker. I found one that I believe is trustworthy and ethical. And on top of that, has good service. Things like full swaps, fast execution speed, narrow spreads, that kind of stuff. Tradersway.com. The link to open up a demo account is in the description below. And, so open up that demo and see if they can earn your loyalty and respect. Okay? Cool, right? I think so. All right, here he is. Okay, quadruple. No, triple. Triple witching. What is triple witching? Hutam wants 5 minutes scalping. We can do that today if you guys want to. Mohammed says, so you're in a turning point. Absolutely. For sure. And I told you 3 months ago, 6 months ago, that this would be the turning point. Yeah, so for sure. So yeah, we are here now. I've been waiting for about 3 months, 4 months. I guess Omicron really ruined fourth quarter, and I knew first quarter would be like this. Now, maybe not the volatility that was added to the quarter because of the Russian invasion of the Ukraine. That, that wasn't a part of the normal business model, but everything else was there, totally fine. And now I'm moving into the next part of the model. Yeah, but nothing unexpected. Okay. Now, the risk to the model, of course, is still the geopolitical situation. Okay. But going back to triple witching, what does that mean? All futures contracts are going to expire today. Options are going to expire today, and stock indices are going to be rebalanced today. Today is going to be the day. By now, you should have somehow. I can't go that high. I don't believe that anybody trades the way I do. Anyways. Okay, so anyways, let's take a look at the world. Japanese yen generally weak. Dollar came back. Okay, that's not unexpected. Kiwi came back. That's not unexpected. In fact, yesterday in the swing trading group, I created scenarios of like plan A for out of position trades. Plan B, your basic price action pullback. And plan C, full double bottom. And so we're in this scenario here, which is the best one actually. So we can go around the world and take a look and see what's going on with that. And there's reasoning, especially on some of the other pairs. There's a lot of reason for things to come down. But like, let's start with euro dollar. Okay. Look at that, huh? Had that nailed tight. Think about it. In the swing trading group, we met yesterday somewhere sort of like in this period. And we talked about this. And sure enough, came all the way back down, tickling the 110. That's interesting, maybe. I don't know. Okay. But the decline, not unexpected at all. Cool. Said maybe, I'm going to have your baby. All right. So anyways, kind of interesting. We also have this at something that's very toppy. Hey. So maybe like this. Gonna have your baby. Or, of course, all the way down, but depends on what you think. USD kitty cat. Got ourselves a boredom. Okay. Gonna want to sort of look at these areas here or trade it like a range. So that's going to be, comes down to your opinion. Oops. So it's either like, let's say, if you believe we're stuck here for a while, then it's going to do that. That's how you'd plan that. Okay. I'm kind of looking inside of this and seeing this. And if I'm a trend trader, okay, I might be able to kind of do one of these things. Aussie, 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 oi, oi, oi. Let's get off the daily, go on the 4H. Okay, and yep. Okay, so one of the things we were talking about in the swing trading group yesterday was, you can't quite see the left, but the left was a great bullish entry. This was a great target. That means that's done. So on the 4th, the month of March was already done. That sets up a trend trade. And get this, in my book I wrote 15, 16 years ago, it says, in this situation, up here in the area that I've circled, very often price comes back there. Now, it's great when you write something, publish it, and it goes into the Library of Congress. And it says, in this situation up top, very often it comes back to this situation at the bottom. Isn't that lovely? Okay. And this is a whole new trade. This is a whole different trade. And I treat them as separate situations. Mohammed, join the live group, because in the live groups, I talk about it till I'm blue in the face. So if you want to know, enter your credit card. I'm sorry, man. It's Friday. I've spent 100 hours in front of my charts. I've spent I spoke for 7 hours on Wednesday, and another 7 hours on Thursday, and like, dude, I'm done. I don't want to talk about it anymore. Right. Plus, I've probably, even in the live streams, have talked about that 100 times. I'm just burnt out, man. I'm done. I don't want to talk about it. Don't want to talk about it. Rewind, man. Rewind, bro. Let's just say it's my alpha, and that's that. All right. Sorry, man. I don't mean to be bitchy. I'm just tired. Okay. So, yeah. So this to this, okay, pink to blue now to the up, is a totally different trade. So this is the trade of the month, done. This is the counter trade of the trend of the month. And now, because of this target, I'm not looking at the monthly, I'm looking at the weekly. This is a counter trend of the counter trend. So it comes down to, what do you think is going to happen next? Okay. And so one of the things I outlined last night was, basically 3 scenarios of how this will work out. Okay. And, this is actually a fairly healthy, a pullback here is actually fairly healthy. And then this is also plausible. So we don't know, but you have to set it up. Need the coffee, man. Need the coffee. It's not an addiction. It's a love. There's a difference. What's up, DK? Can I analyze the S&P 500? Yes. Am I going to? No. But I can tell you my stock portfolio is profitable for the year. Despite the decline in the markets of 10, 15%, my portfolio is profitable. And hopefully just warming up. La 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 la. Take a look at commodities. Okay. Luflitulumum. Okay. This moving average is based on the hourly chart, and yet we're on a 5-minute chart. You can see the up. Oh, let's change colors here. You can see the up, down, buy. Okay. Up, down, buy. Up, down, down. Oh, stopped out, right? Down. Oops. Actually, that wasn't me. That was a glitch. Down, and then up. And now you're in sell mode, right? Down, up, sell. Down, up, sell. And that's what we are on this 5-minute chart relative to the 1-hour chart. Wow, look at Robin getting all romantic. Huh? Getting close to that wedding day. Did we stop trading Seek? No, but Robin and Steelan's been focused not only on Seek and Destroy, but on Noke. Norwegian Kron, because of Brent. Yeah. Yeah, Robin's all romantic. Getting all lovey-dovey. That's good, man. I used to be all romantic and lovey-dovey. Now I'm just a bitter old man. I went to the country club last night for St. Patrick's Day because I had a special meal and decorations and party and music and, you know, Irish food, and all the drinks are green. So we walked in, and we were by far the youngest people in the room. My wife and I were by far the youngest. I'm like, oh my God. Oh my God. So it very quickly you can feel like, oh man, I'm getting old. Suddenly, like, man, I got to party hard because I'm going to find myself in this room in 20 years. I gotta live like I'm young because I'm still young, man. Right? What a great opportunity to turn your mental state around, huh? Live while you can. Is that right, Robin? That's cool. Yeah, Irish food. Yeah, I did actually have a Guinness. I asked the waitress, I'm like, are you guys serving green beer? And she's like, yeah, all the drinks are green. I'm like, oh, well then give me Guinness then. What am I going to have, a green Corona? Burton says, run naked over the Harvard campus and feel 18 again. Yeah, maybe. I'll be there shortly, in fact, picking up my second degree, which is interesting. Should be an interesting day. So there we are on the 5 min, guys. So you just stay with that for a while and see if WTI. So you have what WTI is monthly, isn't it? So you have the MAR, and then rolling over to April. That's occurring today. So you got to get out of March and into April if you want to stay with it. We call that rollover. But some futures contracts, they're actually Jan to April, right? So some futures contracts are monthly, some are quarterly. But so the ones that are quarterly, the rollover is today. So whether you're in a monthly futures contract or a quarterly futures contract, they are expiring today, right? Maturing today and rolling over into, so the front month is dying and the back month becomes the new front month. All of that's happening today. So you could, like in a true futures contract trading platform, this would be like WTI MAR, and you'd have to exit this one and then roll it over your position to the April contract. Okay. So that's what's happening today. So I believe it's 3 trillion? $3 trillion of futures and options expiration today. Meta, why today? It's just the end of the third week of the third month. So whether it's monthly or quarterly, it's just this is the time it rolls over, right? No, it's not a silly question. It's just the end of the quarter is what it is. 3.5 trillion. Thank you, Ashish. Yep. Just end of the quarter. Okay, taking a look at Goldilocks. That was the trade plan. What do you stink? We got ourselves a beautiful little bottom, and I love beautiful bottoms. Okay. So that occurred over 3 days or 2 days, 2 or 3 days. So we call that a J-low. Why do we call it a J-low? Because it's a big wide bottom. So anyways, we're looking that way. I know it's sexist. I apologize. I know. So what do you think? Is there a chance here? Yeah, there's a chance here. It's a beautiful trade. Don't let it get away. It's a beautiful trade. Buy me, take me to that higher place. Please, my trade. You know I'm not a hopeless case. Uh-oh, Jim. Oh, Jim. Careful. Wayne, when USD go down, should gold go up? Well, theoretically, whereas my uncle used to say theoretically, if dollar falls, then if nothing changes for gold, then yeah, you'll need more dollars to buy the same amount of gold. In theory, gold never changes value. Oh, truth doesn't matter, Jim. Truth does not matter. All right. Yeah, so the theory is gold never changes value. Gold is gold. 1 ounce of gold will always be 1 ounce of gold. Or, right? Or 1/16 of a pound. No matter how you look at it, you can measure it in stones. You can measure it in whatever you want, but right? A unit of gold is a unit of gold is a unit of gold. So therefore, the only thing that changes is how much you can exchange for it. It's all about a trade. You're like, I have some gold. What will you give me for it? I'll give you 1,000 loaves of bread. Cool. You're like, well, I was thinking closer to 2,000 loaves of bread. But of course, loaves of bread now have gone from $1 to $2 to $3 even, right? So let's say a loaf of bread is now $2. has the loaf of bread changed? No, the dollar is weakened. So you used to get $1 used to buy you a loaf of bread. Now it's 2. Now if you're a long-haired ponytail dude, your bread is like $5.95 because you're a fake hippie. Okay? So, you're right. But anyways, a basic loaf of bread used to be $1. Now it's $2, sometimes $3. So the cheap loaf of bread hasn't changed. The value of the dollar's changed. So yeah, so one theory is, gold is gold. Now, what you're asking is, because of dollar weakness, do people want to buy gold? Maybe, but not necessarily. So one of the things I would look at if I was me, Theta, is I would compare GDP to inflation. Now this is smart. So I know your other gurus on the internet say, oh, inflation is high, buy gold. That's not actually quite true. And in some of the cases, it looks like it's true. But in many other cases, if you pay more attention, you'll find out the dollar can weaken and so does gold. And you're like, wait, that doesn't make sense. Okay, so then what does make sense? When inflation, okay, so let's do this. If we'll put nominal GDP is Y, okay? So we'll restate this as Y, and we'll restate this as I, okay? So when Y is equal to I don't think gold will go up. Okay? When Y is greater than I believe gold will actually fall, even if the US dollar is weak. Doesn't matter. And when when I is greater than Y, I believe then gold will go up. So I want you to look at, let's say core inflation. So now you can do, this, I star if you want, and make it core. Maybe you just do headline, or do you use PCE instead of CPI or something. I don't really care. But you look at some measure of inflation and you measure it towards growth. Okay? So you might find the Fed in May or June comes out and they do balance sheet reduction, which does what? Okay? They sell their mortgage-backed securities. Okay? Somebody buys it from them, let's say Freddie Mac or Fannie Mae. So it goes, let's say, to Freddie Mac. Freddie Mac sends the Fed, let's say, $1 trillion. And what happens? The Fed destroys that $1 trillion. And inflation comes down a little bit. I think that's much more important. The balance sheet reduction, I think, is significantly more important than Fed funds rate. Okay, so Byrne says, isn't gold just an insurance for hyperinflation, not just inflation? Well, that's somewhat what I'm talking about. So last year, the stock market was up at least 20%, correct? And we had high inflation, right? Okay. This was stocks. We had high inflation, and gold did nothing. Gold did nothing last year. You would have been a fool to have invested a significant amount of money in gold and not the stock market. And so you'd say, well, we had CPI at a 20-year high. I know. You made the wrong trade. Because growth was high as well. So you should have had growth stocks, for example. Think about it. There are many stocks that were up 100% over the last couple of years. Some were up 200% over the last couple of years. And you bought gold that went up 0 because of high inflation. You didn't look at growth. If some stocks were up 200% and inflation was up 4.5%, then who gives a crap about gold? Pardon my French. You're not thinking about it right. So you got to be very careful. To the 20-year-old guru that is on YouTube that now gives investment advice, they weren't even around in 2008, yet alone the 90s, right? Let alone the 80s, to understand things like what happens and how you take a, because unfortunately, even if you get a college degree, they'll say things like inflation up, dollar, or let's say currency falls. And then central bank raises rates, currency rises. And people have these general rules of thumb. They're like, okay, that's how it is. That's the full equation. No, it's not. It's not the full equation. They're giving simple, basic rules of thumb to an undergraduate student that takes 2 classes in economics and then moves on. If you only took 2 classes in economics, they're going to be micro and macro, which is like the elementary level of economics, so that you have a basic, rudimentary understanding at a fluffy level. And of course, there's no calculus or anything. There's no deep dive in any of those classes. So at best, that's what your guru has, at best. Usually they don't even have that. So if you go deeper dive and you get a degree in economics, then you pull all that apart and say, well, that's kind of true, but it is just the same very much not true. And you have to understand the nuances, right? Now, Peter goes back to the balance sheet reduction. Okay. And so the Fed can come out and destroy some of the money they put in. And that will kill some of this inflation that we have. But the problem is the balance sheet reduction is only from the Fed. Okay? The White House put money into the market, and they can't destroy it. How does the government take the money back out of the market? I guess they could take cash. The Treasury could just take cash and burn it. I don't think that's going to happen. You could tax things, but what happens? You bring the stock market down. So as a politician, you're fired, or you raise taxes and just directly the next election, you're fired. Okay, Theta says savings and investment. Governments don't save. And investment requires more borrowing because the government doesn't actually have any money. So if you want to invest, right, you're going to have to then borrow and then invest the money and get a return on investment, which takes too long. So the White House, like any White House, this isn't just Grandpa Biden, but the White House is not going to do something that destroys money because they will lose the election. Okay? So, like, what does this White House do to win the election? They gave people free money. Okay? So we have a free money White House. Okay? And so if you ask, Wayne, how did the Fed do Q1, Q2, and Q3 and not create inflation? How was that done? Well, the way that the Fed works is they can put money into the market. Q1, Q2, and Q3 are all examples of the Fed creating money. But they can also destroy the money easily. And the Fed is about to start the process of destroying money. When this group created free money, well, they actually had to borrow it. You understand that first problem? The Fed can actually create it. They can invent it. They can just add ones and zeros. The U.S. government cannot do that. Only the central bank can do that. So the U.S. government went out into the open market and borrowed money. And then gave the money to people for free. Zero return on investment. The only return you could probably argue is that prevented the economy from crashing into depression. I would argue that the Fed did more than enough. And we didn't really need that free money. Now, maybe something like the government could have simply extended unemployment benefits by a great deal of time. And maybe a couple of other things. I'm not sure we'll pay your rent stuff. That was kind of weird. I'm not sure. I don't know. Maybe that was good. Maybe that was bad. But look, if you were collecting unemployment, then you should be able to pay your rent. You see? Like, what happened to that? Like, you don't have to pay your rent. Well, I thought you were on unemployment. Okay? So that gets weird, but for sure you got to do something to help, because if you listen to Keynes, and I think even Hayek agreed with this, when the economy is doing well, you should tax people and save the money. Pay down your debt, for example. And then when you hit a recession, because it's inevitable in capitalism, so if you don't understand that, then you're not a leader. But when things are bad, that's when the government borrows money, spends money, and supports the population. And then the economy recovers, and then you raise taxes again. That's how it's supposed to work. That's how capitalism is supposed to work. And of course, politicians ruin that. They spend money when times are good. They spend money when times are bad. They spend money when times are good. They spend money when times are bad. They spend money when and we'll see if that changes if crypto comes along, right? But anyways, my point is, this is what created the inflation. Because we didn't do that last time during the 2008 financial crisis. And so the Fed did quantitative easing 1, 2, and 3, and we didn't have any inflation. We went all the way back to full employment. We had a 10-year bullish market for stocks. People that had careers, not just jobs, but those that had careers and savings accounts and retirement accounts, things like 401ks, people that owned small businesses, they made a killing. The rich got much richer. And those that don't participate in the financial markets stayed poor. But that's how it works. So now we had this great experiment because no one had actually done this before. And the government looked at Q1, Q2, and Q3 from 2008, and they're like, dude, you can just print free money, trillions of dollars. It doesn't matter because it won't create inflation. So we did it once, right? Trump did a trillion, Biden did a trillion, and then another couple of trillion. And so eventually 5 trillion was added, and boom, we got inflation instantly in less than 1 year. This after 10 years of Q1, Q2, Q3, there's zero inflation. And then within 1 year, we had crazy 10% inflation, out of control. And it's because this free money is non-productive. Okay? And what do I mean by that? Well, productivity, GDP. GDP is growth. So you could change this and say, for your money, sorry, that was supposed to be money. For your money, what was your return on investment? Okay? That's how you need to look at things. That's how a business looks at it, right? So you change to this. Okay, if you make an investment, you should have some sort of return for your investment, right? What does that mean? Okay, you invest $1 million into an apartment building, and in 10 years, through amortization, asset appreciation, and increasing rents, it will be worth $1.5 million. Correct? Would you make that investment? Maybe. If you did it and you said after 10 years it's going to be worth 0.5, even after amortization, would you make the deal? No. Well, what about if you invested and your investment will produce zero? So you'll make $1 million investment today, and in 10 years it'll be worth zero. Would you make the deal? No. So that's sort of the problem. We borrowed the money and burned it. Now you say, well, you didn't burn it. You helped a waitress at Applebee's pay her rent. Okay, well, there's some level that the government needed to do. I get that. So you do the unemployment benefits, right? And you extend that for longer periods of time, but it wouldn't be $5 trillion. It would probably have been 500 billion. Okay? Now, if you took that and also did 500 billion in Build Back Better, let's say actual infrastructure, not sort of fake infrastructure, real infrastructure. You rebuilt bridges and rebuilt roads, rebuilt ports, built nuclear power plants. Okay? Stuff like that. That's good money. That's money well spent. This is sort of preventative. It's like saying going to your dentist and having your teeth cleaned is a waste of money. Well, no, it's sort of insurance, right? Okay, good. Okay, I get that. That would have been good use to stabilize the economy and make sure people can pay their rent, can buy food. Because if that 500 billion in unemployment, all that unemployment gets saved. I don't think people on unemployment save money. I don't think they have enough. They barely have enough. They probably don't have enough and might have to draw down their savings. Gotcha. Sucks to lose your job. It sucks to shut down the entire economy. I get it. It sucks. It's supposed to suck. I can't afford my Netflix if I'm on unemployment. Yeah, I know, right? Okay? So it's supposed to suck, but that might be a good use of money on the short run. And then you take another 500 billion and you got a return on investment, which might have paid for all of that. Great. But that's only 1 trillion. That's 80% less money. So again, the Fed came in, stabilized the banking system, which actually never was in jeopardy. They saved the housing market, which actually never was in jeopardy. They thought it could be, and maybe it would have been. So the Fed came in, but once the Fed realizes enough is enough, they can just destroy the money, and we would not have had inflation. Even the balance sheet going with mortgage-backed securities was probably a mistake. They overdid it. Okay? They tried something new, and it was probably not a good idea. So, but they can destroy that. They can just sell those assets to somebody else, take the money back, and then destroy the money. Just literally take it out of circulation, or actually just actually kill it. Someone transfers $1 trillion to the Fed, and the Fed just gets rid of it because it's just ones and zeros on the computer, and they're like, okay, 1 trillion gone. Okay? But the federal government can't take back the $4 trillion of overspending that had zero productivity. Okay? So if you think like ROI is equal to 0, then you've lost. In terms of currency, it's just 1 trillion, let's say, dollars that are worth 0. It's actually 4 trillion, right? They're worth 0 and they're in circulation. So what does that do? The value of the dollar goes down by the total amount of dollars, right? Increasing its purchasing power, or sorry, you take the old amount of money, number of dollars, and its value. So how much gold can it buy? How many Big Macs can it buy? Then you add 4 trillion more, plus 4 trillion, and it's now worth 0. So the per dollar purchasing power minus the 4 trillion of worthless dollars, you get a certain percent, and you might find out, let's say, right, that this equals out to a 5% drop in the value of the US dollar. And because it's non-productive, it drops the dollar and increases gold. Okay, you get that? So again, we go back, nominal GDP versus your measure of inflation. And if the country is productive, people are working, factories are working, everything is golden, you will get inflation, but it's offset by productivity. You see? Okay? So your spending is equal to someone else's income. Income. Think about that. You take some money and you go to Applebee's and you buy dinner. Probably 95% of the money goes to pay the rent, pays the insurance, pays the mortgage, pays the electric, pays the waitress, pays the cook, the busboy, the maitre d', the owner, all that kind of stuff. And there's some leftover money, which they save. Okay? But what does the waitress do? She goes to Supercuts and gets her hair cut. pays her rent, buys groceries. And now it's someone else's income. And the Supercuts person now has money. It's their income. Okay? Now, the person that owns the Supercuts and the person that owns the Applebee's, they get a distribution because they're an owner. And that becomes their income, right? They don't need it because they're already rich, so they save it. So you have savings now. And they put it in a bank account. And what happens to that? The bank lends it out to somebody else so that they can get a mortgage. Okay? So you save some. Maybe you save for retirement. It goes into a 401k. Or you save it in a bank. It goes into a mortgage. What I'm getting at is there's a fixed amount of dollars, and it goes around and around and around. This dollar goes to this person. This person takes the dollar, go to that person. That person saves it, and it gets put into this person's house, so on and so forth, right? We call that velocity. Velocity. Sorry, velocity. Sorry, velocity. Velocity. We call that velocity. This money goes from you to this person to that person, back to this other person, and it's the same money exchanges hands. Why? Because money is fixed. Therefore, you cannot create inflation. How could that be inflationary? Your money goes to somebody else. Your money goes from that person to somebody else. Your money goes from that person to that person to that person. And then all of a sudden, you get paid at the end of the day. Why? A customer paid your company money. And your company paid your salary. And then you paid your mortgage. You paid your car insurance. You bought groceries. And you went to Applebee's. And then, right? And it's all of a sudden that waitress has money again. But it's the same money. It just went around and around throughout the economy. You cannot create inflation. Why? Money is fixed. Look, the quantity of money, the value of money. Okay? Now, based on the value and the quantity, you get a demand function. But how much money is there right now? This amount of money. It's a vertical line. The supply of money is that. How much money is in their economy? That much. There's not a little bit more or a little bit less. That's how much money there is. You cannot create inflation. Now, based on demand, money can get more expensive or less expensive, but its purchasing power doesn't change its quantity. Okay? Let's just, for example, say there was $5 trillion of money. Now, that money maybe buys more gold. The value of the 5 trillion went up. Or maybe it buys less gold, then the value of the 5 trillion went down. You can't create inflation. It's impossible. So every dollar has a demand and a return on its investment. Theta says the interest rate changes with the amount of money. No, it changes the value of the money. So when you raise interest rates, it gets expensive to borrow. Okay? And all they're changing is the demand. So what does this chart say? Let's break this down. Okay? If the value of the money was high, you wouldn't need much. If the value of the money is low, you would need a lot more. Okay? So the demand would change, but if there's only a certain amount of money, then it's how much are you willing to pay for it? How, so the value can change, but the quantity doesn't. What happened is the government came in, and changed the supply to supply 2. So quantity 1 went to quantity 2, increasing, how much money there was. Here's the old equilibrium. So now you got the value, and now you have a new, and what did it do? The value of every dollar went down simply because you increased the supply. So what the Fed can do is add money for a couple of years until the economy is recovered, and then it could just easily destroy the money, and we go back to supply 1. We go back to supply 1. Add it till we need it, we spur the economy, and then we take it back. The problem is the federal government created the money, and we can't take it back. Unless you jack up taxes, but if you jack up taxes, you're going to lose your political election, and then what was the point? C3 says, are you still a long-term bear in the US dollar, even though, and that's the part where you're wrong, the Fed will keep increasing interest rates? Yes. So go back to the equation. Y, let me redo this. Y is equal or not equal to I. Y, again, is nominal GDP. So right now, you have a situation where I is higher than productivity. Yes, that would be bullish for gold. That would be bullish for a lot of different things. Now, at some point, interest rates will be so high that inflation will come down. And the big part of the inflation dropping significantly is because, this idea that it's costing too much to borrow, so therefore you crush the economy, and this whole thing collapses. So now you have to look at yield curve. And this is actually full circle now, which is kind of interesting. We talked about balance sheet reduction, in my opinion, is more important. Why? Well, let's go back to this. This is the 1 year, the 2 year, the 5 year, the 10, 15, 20, and 30 year. And we'll call this rate. Rate and duration. The Fed funds rate is going up. And they told us for the next 2 years, interest rates are going up probably like 10 times in the next 2 years. So we know that it's factual. So the Fed funds rate, let's say, went from this level to this level. And now they've told us that this will probably okay, go somewhere higher and so on and so forth. Oops, I didn't mean to do that. So what we want is a yield curve that looks like this. What's happening is we're only changing right now sort of the 1 year, the 2 year, and the 5 year, and it's steepening. Okay? At some point in that equation, what I was showing you is we will be at a rate like this. That's the inverted yield curve I care about. Okay? Where this, let's do this in black. This is higher in percentage than this. A 1 year or a 2 year is higher than a 30 year. And that is a normal inversion. This, when you hear about an inverted yield curve and it's going to crash the economy and a recession is coming, that's the one you want to look at. Now, what people are talking about now, shoot, I did it again. Okay. What people are now talking about is we kind of look like this right now, or let's say last week we kind of looked like this, and now it kind of looks like this. And in fact, it's even pivoting a little bit in the middle, but nonetheless, we'll just do it like that. And people are going to say, this is inverted here. Let's say next year we're at a situation like this. And the market will tell you, oh my God, the market's going to crash because this is inverted. And what they're not understanding is the meaning of this. All they're looking at is this is higher than that. But is the market going to crash when you can get a cheap mortgage? You have a good job? You're making good money? Stock market is up? The value of your company is up? And you get a cheap mortgage you can afford, and the value of your house is going up. Okay? Yes, it doesn't actually have to flatten. Flatten just means level, let's say. Okay? But nonetheless, people don't quite understand this. So you got to be very careful. A lot of people are talking about, you know, like the 210 inversion, the 2.5 inversion, all that kind of stuff, and that means this, we're going to have a recession next year. I'm not with that camp. But let's talk about then why the balance sheet reduction. Oops. Because that's what I want to talk about. I said this is much more important, the balance sheet reduction. Okay, and we'll start with the mortgage-backed securities. Okay, mortgage-backed securities. And we'll say a mortgage is a 30-year. So we're talking about this end of the curve. So if the Fed, let me redo that one. Okay, so we're talking about this. So if the Fed reduces that and sells it from the balance sheet, reducing the balance sheet, and then they destroy the money, right? But what happens? Okay, prices fall and the yield rises. So now we got to go to sort of an orangey color here, a brighter orange. And all else being equal, what happens is this happens. So as we're in this process, this will go up because the Fed will raise interest rates. Then they'll sell some mortgage-backed securities, and then they'll raise this. And then they'll raise interest rates again, but the Fed has sold some mortgage-backed securities. Then the Fed will raise again, and then they have sold some more securities. And what'll happen is, okay, is that process. Okay? Now let me ask you, has anybody else in your life anywhere, on TV, on YouTube, in your classroom, explained the monetary policy mechanisms in place like this of increasing Fed funds rate, but at the same time reducing balance sheets to avoid a recession? Has anybody drawn this out for you like this? Okay. Okay. It's important to understand this because I don't think even a college professor would do it that way. But that's what is in mind. Okay? Now, Richard says it's too early. We have to wait for the data to support that narrative. No, dude, no. You don't have to wait. That's the model. And they're discussing what needs to happen first and at what rate and what's the terminal rate. And so, but it's going to happen. Okay? And this is what the lexicon of our conversation is right now, especially amongst very sophisticated, institutional investors. This is the narrative that they're talking about. But then when I hear people on the news and they're like, oh my God, the Fed just outlined 7 rate hikes this year and probably 3 more next year. That's going to raise the Fed funds rate. That inverts the curve and we're going to be in recession because that means recession. No. No, it doesn't. Okay? But there will become a point where the balance sheet has been reduced. They own 0 mortgage-backed securities. And maybe we've had another 10-year rally in the stock market and your house has doubled in value and everybody's got a job and we're a million years past, the last couple of tough years. And what happens then? We get that good inflation. And what does this mean? Okay, this would mean, okay, this 5%, let's say, level of a Fed funds rate, and this 4% 30-year bond, okay, that would indicate that we're well above potential GDP, which is Y star, potential GDP. We're well above that. And now your businesses' short-term borrowing costs are higher, right, than, let's say, profit margins. Because you have to pay more for your rent, more for your electricity, more for your employees, more for your insurance, more for your advertising, all that kind of stuff. Because everybody's rich. Your landlord's rich and they're jacking up rents because he's got 5 other companies that are willing to pay more than you for the rent. So anyway, so when we get to that point, okay, you will get a recession. Okay? So we're a long ways from that. We're a long ways from that. Okay? This is a non-stimulated economy that is just booming on its own. But this is generally, right, created from real demand for real products, real services, and not some BS nonsense fake money pumped into the economy. So we got to destroy that fake money, and that will slowly create this ladder, if you want to call it that, of increase in Fed funds rate, but increase long-term return on investment. Okay? So we got to destroy that fake money, and the problem is the Fed can only remove half the fake money. Now, C3 says, I always assume higher Fed rates would cause the dollar to strengthen. Okay, you can believe that. Now, I disagree with you, but it doesn't matter. But that's what your textbook in college tells you. But remember, your entry-level economics, whether it was in high school or college, your Economics 101 is only explaining the most simple and basic of models. And I'm sure when you learned that increasing interest rates increases the value of the currency, they didn't say, oh, but in this particular currency, it's a reserve currency. I'm sure they didn't make that distinction in your Economics 101. They're just like, okay, higher interest rate increases demand for that, and therefore the value goes up, and you're done. Yeah. 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 But that's a very simpleton point of view. Now, if you separate and say, well, there's a reserve currency, and then there are non-reserve currency majors, let's say, right, C3, if you say the Bank of England is raising interest rates, and that could increase the value of the British pound, then that's probably closer to reality. The United States dollar is special. That's not an opinion. It's the reserve currency. Okay? So what does it actually mean? What does a reserve currency mean? Central banks around the world need to have US dollars in their vault, in reserve. Now, why? Think about it. Why? I'm about to give you a PhD in economics. Why? Well, when their countries are doing business with the United States, right? Buying stuff, borrowing stuff, trade, whatever. The companies in that foreign economy and the people in that foreign economy, they need to pay for that activity in dollars. So they go with their local currency and they're like, okay, central bank, wire the United States of America 1 million US dollars. But because that's the deal they cut with the American company. They purchase something, let's say. So there's business activity. So the central bank now has to convert the local currency into US dollars, which means they have to have US dollars in the vault. Okay? Things like oil. Great. So when do central banks need this? Okay? When there's lots of business activity. Now, right? Now, the interesting part is it's when business activity is good, but dollars are leaving the United States, because what's interesting is the local guy is demanding a lot, but America is 10 times, maybe 100 times bigger of a country. America is a very big, very wealthy country. So when times are good and the stock market's going up, the value of your house is going up, you have a job and it's a good job, you're getting paid well, and you figure there's going to be a pay raise in the future, or you could always get a different job at a higher rate somewhere else. You feel really good. What do? You buy a BMW, you buy a new Samsung or iPhone, you buy a giant TV, you go on vacation to an international country. Okay? You buy clothes, probably made in a place like Vietnam. And what are you doing every time you're doing this because you feel good? I want you to think about that. You have a job and everything you own, or all your assets are going up in value. So you spend more. It's the household wealth effect. Okay? It's part of behavioral finance. When you feel good about now, but more importantly, the future, you're more likely to consume or invest, but more likely to consume. And when you consume, you are selling the US dollar. And those dollars go to central banks around the world. So you're buying some Nike shoes, $150 for a pair of shoes that cost $12 to make. Why do they cost $12 to make? There's a factory in Vietnam. So you are short selling the US dollar and longing shoes. What do you long for? You long for a new big TV? You want an OLED TV? Yeah, that's LG, baby. So you're long OLED and you're short US dollar. Remember, they're just conversions. I want an OLED TV. Oh, you want to sell your dollar? No. Well, that's what you have to do. Oh, well, I don't know anything about the dollar. You have to exchange your dollar for an OLED TV. OLED TVs are beautiful. Not that fake OLED that Samsung has. Oh, no, they're like nanos. Shut up. It's either an OLED or it's not OLED, right? So you sell your dollar and exchange it for a unit of television. So you go to Walmart and you buy some socks. No. You're selling your dollar and it's going somewhere. So when things are good and Americans are rich and they feel rich and they expect to be rich, they're selling dollar to buy BMW. They're selling dollar to buy a $2,000 iPhone with 17 cameras on it because their old phone only has 15 cameras. Good. Do you do that when you're poor? No. God, I can't feed my kids today, but I love this frickin' phone. Okay? Here's a great example. There's a Samsung. I shorted dollars and got a phone that has folding glass. Yeah, love it. Shorted a dollar, went long Korean won. Okay? So that only happens when I feel like I can feed my children. When I feel like I can't feed my children, I don't buy a $2,000 phone. Okay? So the behavioral finance first, but, okay, Y is equal to C plus I plus G plus exports minus imports. Okay? X minus M. Okay? The United States exports a lot, but imports more. X is therefore less than imports. Okay? When we export, money comes in. That's all this says. Exports means money in. Why? We send some wheat somewhere. What do we get for wheat? Money, honey. Cool. Now we also import. Okay? Money out. We send money to Vietnam so we can have some shoes. We send money to Korea so we can have a phone. Money in, money out. Wait, and I got this backwards, right? Sorry about that. We import more than we export. Sorry about that. Okay? So there's more money out than money in. Okay? Which means, the value of the dollar falls because world supply, okay? We call this the interbanking system. In the world, sitting out in all the banks, all the central banks of the world and all the commercials, right? Okay, here's the equilibrium. Quantity 1 or quantity E equilibrium. Okay, value equilibrium, VE. Okay, and world supply of dollars. So, because the United States has purchased and imported more stuff than they exported, they sent money around the world that goes into the vault of central banks. So, supply has increased to quantity 2, which means the value has fallen to value 2. Why? Because Americans are filthy, stinking rich. Okay? I have a 120-inch 4K, right? 120-inch 4K, man. Right? Boom, I'm selling the dollar. Where did I get a 120-inch 4K? China. Thank you, China. Whoop, whoop. Xiaomi. Love Xiaomi. Right? Cool. Xiaomi. Okay. I sent them money. The money had to go to China, sit in the Chinese vault. And then Xiaomi got yuan from the central bank. How, right? Isn't that nice? So the world supply of dollars went up from quantity QE, quantity equilibrium, to the new quantity, which is bigger than the old quantity, and lowered the value. So when Americans are filthy, stinking rich and are buying Louis Vuitton handbags, okay, they're buying euro and selling dollar. Okay? Oh my God. Oh my God. Yeah. So be careful, everybody, of relying on oversimplified models. And that's going to be dangerous. Like when you're hiring a guru, let's say you're going to take a paid training course, or you're going to join a group, or you're going to listen to someone on YouTube. Most likely they don't have an economics degree, and maybe at best they've taken a entry-level economics class, and they know the basics. The problem with that is they're still undereducated. Maybe they're not uneducated. I'm not saying they're dumb or stupid, but there's probably two things wrong. One, they've never studied a much more complicated model, and we live in a complicated world, but they probably don't have 20 years of experience. So they haven't seen 3 or 4 or 5 different business cycles. Do you understand that? If your last guru is under the age of 30, okay, they've never even been through one business cycle. They've never even been through one business cycle. They don't understand quantitative easing, yet alone were they there. I was there when they invented quantitative easing. And then QE2. I watched the press conference live of Ben Bernanke and Hank Paulson going to Congress a week after they were at Congress and asked for significantly more powers and more money. And the Congress asked, well, why are you back so quick asking for more? And they're, because the end of the world is about to happen and you guys are acting too slow. Oh my God. Like, I watched it live. And maybe, because I actually sat in an economics class at Harvard, and the kids read about it. We talked about it in class. They read about it in a textbook. I'm like, it's so funny. Well, they were 8 when it happened. And now they're probably your new guru, right? So you got to be careful. There's a big difference between sort of getting some basic knowledge and having lived through it multiple times. Okay? So be careful. Be careful. Yeah. No, I used to party with John A. MacDonald. Anybody know who John A. MacDonald is? Yeah. Then you're not on the... You need to be in the know. Yeah. Got to know these things, guys. Yeah, man. Yeah, the first Prime Minister of Canada. Also the Earl of Dufferin. The Marquis of Lorne. The Marquis of Lansdowne. The Lord Stanley of Preston. The Monarch of Victoria. Yeah. Dude, look at him though, huh? You know he's a player. Yeah. Yeah. How cool is that, huh? All right, I think I'm going to go. Okay. By the way, did you see the headline? Foreign reserves in India for US dollars have fallen. Do you guys remember why foreign reserves of US dollars went up during Omicron? Because they were devaluing their own currency. Because the rupee had increased too much. So they bought gold and they bought US dollars. Therefore, their balance sheet remained the same, but the value of each rupee fell as the supply of rupee in the world market increased. The value went down, which is what they wanted to do. Now the world is stabilized, and India is now selling dollars. Maybe I want to sell some dollars too. Richard Spencer, so you're Canadian. I'm an international man of mystery. Burns says, isn't China buying gold and all that kind of stuff? Yeah, but I would argue probably a year and a half late. But nonetheless, we'll see. But remember, central banks buy and sell gold for much different reasons than you do. And gold rallied from like 1800 to 2000 because of the foreign exchange market. Then gold died. They didn't need any more. They already devalued their currency. Now global trade is picking up again in many cases, except for China. And so India is like, you know what? Now we're worried about inflation and all that kind of stuff. So we will sell some US dollars and bring back some rupee and kind of keep the Indian rupee stabilized. Lovely till you, Mum. Well, you got to think like a central banker. And if you're going to think like a central banker, you're going to need an education in monetary policy. And we have a training course at FX Bootcamp that's probably, 15 hours long. And that's included in the $88 membership. Okay, there's 65 hours of educational videos, of which 15 to 20 hours are dedicated to monetary policy. In a matter of, within the first 4 hours of training, you'll be learning how to manage the balance sheet at a commercial bank so that you can understand how the balance sheet is managed at the central bank. So if you're wondering about what does balance sheet reduction even mean, oh my God, pay the money, fxbootcamp.com. Hurry up. Why have you been waiting? Hurry up. Hurry. You need to know, yo. So I wish you the best. Have a wonderful weekend. Once again, get ready. Triple witching. Okay, the market just opened. So there might be a little more volume and volatility today. And I'm already looking for Sunday, where I'm meeting with my day trading group to get some trades on and hustle the Sunday open. So I mean this from the bottom of my heart. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful weekend, y'all. Cheers.